And now that we see that you can take delivery in gold in Shanghai Exchange in Hong Kong right now, and the second one is being built in Saudi Arabia, who was the fifth partner that signed up as a full member of the bridge technology? It was China, Hong Kong, Thailand, UAE. They developed it with the BIS Innovation Hub. And the fifth member, you remember? Saudi Arabia. They signed up after as a full participant. Well, where's the second vault being built? Oh my God, it's Saudi Arabia. How the hell did that happen? So Saudi Arabia will sell their oil to all of these Asian countries. It'll settle over the bridge network. The West will have no idea, because SWIFT can't even see it. Zero idea of how much they're doing. It'll settle in 7 seconds without going through the SWIFT banks. And it will be then, they'll take all of those currencies of the Asian nations, and they will settle in gold.
The Shanghai Gold Exchange, SGE, officially launched its first offshore vault in Hong Kong on June 26, 2025, along with 2 new yuan-denominated gold contracts. The vault is operated by a subsidiary of the Bank of China, Hong Kong, and aims to facilitate international gold trading and storage settled in yuan. Meanwhile, SGE has announced plans to build a delivery sub-warehouse in Saudi Arabia, signaling deeper integration between Saudi Arabia and China in petroyuan and gold-linked trade. This development enables oil-producing nations to receive gold directly, thereby bypassing SWIFT protocols. Andy Schectman, founder, president, and CEO of Miles Franklin Precious Metals, highlights that the July gold contract's delivery volume had its worst start in years. Still, it experienced a significant mid-month rally, making it one of the most successful minor months in recent memory. It has only fallen short of the blowout month of March in the past 15 months. The August contract is still moving forward. The rapid outflows and soaring deliveries suggest increased institutional and sovereign demand, potentially signaling a shift from paper gold to real bullion holdings. As COMEX inventories shrink further, price premiums on physical gold may widen, and supply tightness could act as a catalyst for a sustained rally toward or above $4,000 per ounce. Analysts warn that continued high delivery volumes, setting new records, could pressure the futures market structure and bolster gold's case as an actual inflation hedge and safe haven asset. Silver, despite August not being a primary delivery month, has also seen large deliveries and strong ETF inflows. September silver is also looking weak, but it is way too early in the month to draw any conclusions. China's silver stockpiles appear to be managed strategically, much like its rare earth metals strategy over the past decade, reflecting sophisticated market intervention. In 2023, most net exports went to financial hubs such as London, Switzerland, Hong Kong, and Singapore, indicating monetary rather than industrial motives. This suggests a deliberate shift from price suppression toward asset value preservation. Such a policy change could remove a key source of downward pressure on prices and fundamentally reshape silver market dynamics, potentially supporting stronger long-term valuations. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
I mean, if you look at the COMEX delivery numbers, you go back to November, but look at them and they're extraordinary. Someone or some institutions have a very, very strong desire for physical delivery. So far, just through the first 3 days of the August contract, we saw 20,126 contracts stand for delivery. That's just in the first 3 days. That's let's just do the math. 20,126 times 100 ounce bars. So let's do that math here. 20,126 times 100, 2,012,600. Let's just call it times 3,400-ish. That works out to $6,842,840,000 worth of gold in the first 3 days of the delivery contract. Silver, this is not a major delivery month for it. We saw 1,064 contracts worth about just over 5.32 million ounces of silver. Each contract's 5,000 ounces. So again, in platinum, 1,006 contract Yes, that's 50,300 ounces. Each contract is 50 ounces. What's really significant, and these are very significant early numbers, especially with gold, seeing huge delivery volume in the month already. Well, this suggests strong demand for physical. And what's really interesting is so far, every contract that has been issued is settling in physical metal, indicating the real demand. And it's like a 1-to-1 ratio. This is significant because you rarely see that happen in COMEX. I've mentioned that to you in years before that, futures contracts are usually closed out before delivery. They're traded for profit or settled in cash. When contracts are stopped, which is what the lingo they use, that means that the physical metal is actually changing hands. Now, in terms of how much is leaving the exchange, a lot. Not all of it, but a lot is actually leaving the exchange. And August is one of the major months for gold, and you typically see higher open interest in delivery volume. But the strong intent to take physical metal where every single contract has been stopped, meaning buyers aren't shutting their positions, they're taking delivery, this is ridiculous. I mean, it's huge. But this is exactly what we've been seeing, the delivery volume and the vault withdrawals, the loadouts it's called. There's been steady outflows, suggesting that loadouts are occurring relative to deliveries more so than ever before. And so I think it's really, really important. It's not a 1-to-1, but it's pretty damn close. And so silver supply, same thing. We're seeing huge deliveries. This isn't a primary delivery month for silver, but still huge delivery, and they're leaving. We're seeing huge inflows into the ETFs. Massive demand for silver, and I think it probably is the most undervalued asset on the planet. But gold is getting the spotlight. Silver's kind of in the shadows. I just think that, look, we've talked a lot about what's going on behind the scenes, where China is quietly stockpiling both gold and silver through unofficial channels, enabling it to purchase silver without affecting the silver spot market. I think that's really where the mystery is, how much silver is being accumulated by countries like China. I think they're making a specific drive to accumulate stuff off exchange, even though we are seeing a lot of deliveries because it's a smaller market. They're trying to keep it, I guess you could say, less apparent to the rest of the world what they're doing. So no, it's amazing the amount of gold that's been delivered in just the first 3 days. But this is what we've been talking about now every month since the beginning of the year, and it's showing no signs of slowing down. In fact, it's showing signs of increase.
Andy believes new legislation regulating stablecoins, a type of digital currency pegged to the U.S. dollar, is widely expected to boost demand for treasuries. Stablecoin issuers could become the second largest buyers of U.S. Treasuries by 2028, with forecasts estimating their holdings to be between $1.2 and $1.6 trillion. The growing role of stablecoins could provide the Treasury with a reliable source of synthetic demand, potentially reducing its reliance on foreign investors and reshaping fiscal policy frameworks. Stablecoin volumes may also blunt the effectiveness of Fed policy. The BIS team notes that heavy offshore demand once caused the 2000s Greenspan conundrum, where U.S. yield movements were muted. They warn that extensive stablecoin holdings could similarly weaken the Fed's influence on Treasury yields. Essentially, BIS researchers caution that their estimates may underestimate the risks a booming stablecoin sector poses to financial stability. In essence, stablecoins backed by debt would facilitate short-term financing, while gold-backed long-term bonds would support a restructured, more domestically focused economy. Now, let's recall the interview.
What is trying to do is to peg the front end of the market, of the bond market, to the stablecoin volume. And it's the fact that the issuance of stablecoins, which I think will blow people away, will grow and grow and grow and grow. In fact, I think you'll see corporations all over the globe issuing them, tied into the system. and they'll be able to, which will then all be backed by U.S. Treasuries. But he said stable coins will create $2 trillion of demand for U.S. Treasuries. And his comment was, we are going big on digital assets. Now, it's funny, the name of my podcast that I do personally, not the one with Michelle, but the one that I do is Little by Little, speaking to logarithmic decay, little by little by little, then all at once. But think back a few years ago, Bitcoin was there, and now everything is here. And stable coins, what were stable coins a few years ago? And now we're going big on digital assets. And they're going to load up all of those stable coin, the backing of it, which will be treasured, all be short-term debt, less than 2 years, because the rates will be much lower on that. That's how they keep the engine moving. And then we talked about revaluing gold to devalue the dollar, backing the long-term treasury with gold, redeemable in gold, as Judy Shelton says, so that the rates are very low, if not nothing, zero coupon, redeemable in gold, which acts as the inflation hedge to reshore your manufacturing. But this is big. Okay, this kind of leads to fiscal dominance, because what it really does is it narrows the Fed's dual mandate, because it will be the U.S. Treasury that will track where and when U.S. Treasury bonds are sold to deliver stablecoins. And so it will be a far greater impact for the U.S. Treasury than it will for the Federal Reserve, who I think has a much greater say on things right now. And this, from that standpoint, is something that I think certainly the administration would like. But, look, this will radically empower, I think, the Treasury, and it will reduce the power of the Federal Reserve. To me, that's part of the reason they're doing it. They say end the Fed. Well, no, but what this will do is because they are going, in my belief, they will allow any corporation that wants to issue stablecoins anywhere around the globe will most likely be able to issue them. And they will all be back with treasuries. It's not just the banks. They'll let major corporations issue them in order to pay for things easier, in order to do cross-border payments easier in 7 seconds instead of 3 to 5 days. This is a quiet play towards fiscal dominance. And look, the Treasury needs lowered rates, and they need a way to market the treasuries when no one wants to buy them. How do you do that? Well, you create a synthetic demand by backing the front end of the curve with stable coins. And then you allow all these institutions and corporations and banks to issue them in the name of convenience and liquidity and expediency. But what you've just done is create the most synthetic demand ever for the U.S. Treasury market, which is debt. And they call it a stable coin that's backed by debt. Does that seem stable to you? It doesn't really seem that stable to me. And it just continues to go. The stable coins back the debt, which enables you to buy more stable coins, which backs more debt, and on and on and on and on. And it's kind of a house of cards. But the long end of the curve, which is the more important end, so this keeps the engine running, will have zero coupon and redeemable in gold. And if you devalue the dollar by revaluing gold to a much higher level, to reliquify the Treasury General Account, to devalue the dollar, yes, you have inflation. Yes, you have a devalued dollar. Yes, it's not good for the average person. But what it will do is will enable us at very, very inexpensive rates to bring our manufacturing back with that devalued dollar. It will enable us to have demand for our new exports.
A fundamental trend toward physical metal ownership by institutions and sovereigns is underscored by developments in the gold and silver markets, which include the SGE's entry into Saudi Arabia and Hong Kong, as well as record COMEX delivery volumes. These developments suggest a more comprehensive rebalancing of global finance, especially when combined with China's careful management of its silver reserves and the growing contribution of stablecoins to the creation of artificial demand for U.S. treasuries. If they persist, they have the potential to erode established market regulations, alter the impact of monetary policy, and hasten the transition to hard assets as a strategic reserve and hedge. How can the worldwide reserve position of the U.S. dollar be affected by the adoption of stablecoins and the growing demand for actual gold? Could a long-term bull market for precious metals be hinted at by China's move from price repression to value preservation in silver? Tell us what you think in the comments section below. We'd be delighted to hear it. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.